you know, yesterday we learned that the Federal Reserve sets the primary interest rate of the discount rate, which is the rate it charges banks to borrow money from it, and the rate banks charge each other to borrow money from each other. It's also known as the federal funds rate. And with regards to interest, that's kind of the baseline interest rate. But what determines the interest rates you pay on, say, a home mortgage or a college loan or a car? Well, again, there's two things: risk and time. That also is what affects the interest rate you get paid on those things. On your savings account or a certificate of deposit or a bond. And so basically, we kind of look at what determines interest rates. Well, the market does. What determines the price of anything? It's supply and demand. Okay. Now, the Federal Reserve can influence interest rates, but basically, if the demand for money goes up, in other words, if more people are trying to borrow money, that is going to push up interest rates because you have a higher demand for money. And then usually the Fed will often counteract that by trying to lower its primary interest rates to push them back down. But when it comes down to it, the market still determines interest rates. And again, the price of money is determined by two things: risk. How risky is the loan? How risky is the investment? The greater risk, the greater the interest rate, or the greater the potential return. And time, or liquidity. The less liquid, the more time it takes to turn an investment into cash, the harder it is to turn an investment into cash, the higher the return, the higher the interest rate will be. So that's why a 30-year home loan costs more than a 15 or 10-year one. So first things first, we have to understand, why do people borrow money? Okay. And then people borrow money. We call that demand for money. Okay. People generally are going to want to borrow money, but why would they want to hold cash as well? Why do people hold cash rather than putting that money in the bank and earning interest off of it? There's generally three reasons why people might hold cash rather than put it in a stock or a bond or a savings account or a certificate of deposit. Okay, there's three. One of them is what we call transactions demand. And that's basically walking around money. Money you want to have for everyday purchases. A business would call this petty cash, but it's the money that people just want to have to go to the store, go to, go out to a restaurant, go just carry out your normal day-to-day activities. Okay. The second is emergency demand. Okay. The emergency fund. And it's a good idea, as you're saving 10% of your paycheck, which is a habit you should get into, that you put money into an emergency fund. And generally that's kind of what we start with. You want to have at least a month's pay saved up, and then work up to 3 months pay, and eventually to 6 months pay you have available to you on a fairly quick and easy basis. And so that way, if something happens, if you get sick, you get in an accident, something breaks in your house, you got to fix your car because your car breaks down, you have cash available to do that. That's what we call precautionary demand. That's the second reason why we might hold cash. The third reason is what we call speculative demand. If I think that the price of, say, a certificate of deposit or a bond or a stock is going to, that the price is going to go down in the future, or if the interest rate is going to go up in the future, I'm going to wait until that price goes down or that interest rate goes up, and then I'm going to buy put the money in the investment, whether it's a bond or a stock or a savings account or a certificate of deposit, whatever it is. Okay. And so the demand for money curve then represents the quantity of money that people will hold, the quantity of cash people will hold at various interest rates. And by the way, holding cash also means taking out a loan. Right? So we may take out a loan, we may borrow money, which is demand for money, to hold cash, to have cash available, usually to make a purchase. Usually that's going to be for transactions demand, right, to make a major purchase. So the lower the interest rate, the less incentive there is to invest, the less incentive there is to buy a bond or put your money in a savings account or buy a CD. There's a greater incentive to spend money when interest rates are low. And again, let's kind of look at the theories of economics here. Remember that Keynesians generally want to stimulate aggregate demand, which means they need people spending money for their model to work. And so as a result, on the monetary policy side, Keynesians have an incentive to try to keep interest rates low, inflation be darned, because of the idea that if people are spending money, that will boost the economy. The economy, and again, the economy is not a monolithic thing. It's not something that can be turned on and off like a light switch. It's not something that can be managed by the government. The economy is individual interactions from you and me and everybody else going out and living our day-to-day lives. But in general, when interest rates are low, we are going to be more likely to demand cash, whether we're going to hold cash that we already have, and again, cash could be a checking account as well, or whether we're going to maybe borrow money to spend it. We're going to buy cash essentially by borrowing money and paying it back in the future. Okay. So how do we figure out an interest rate? Well, at any given point in time, the money supply curve is vertical. Okay. So at any given point in time, there's a fairly fixed money supply. Now, obviously, as the money supply grows, that fixed money supply is going to grow as well. And so what happens is, okay, and so here on this graph, our y-axis, our vertical axis is the interest rate. Our horizontal axis is the money supply, the quantity of money, okay? So what happens here is that when we increase the money supply, the interest rate goes down. Why? Because money is less scarce, okay? There is more cash out there. People are going to, therefore, have more cash available. And as a result, the interest rate will go down, okay? Because more people will be holding cash. So money is less scarce. It's less costly to buy, okay? That's why interest rates drop when the money supply grows. And also, this can go the other way. A drop in the interest rate when the Federal Reserve, for example, lowers the interest rate through either bond purchases or through just coming out and lowering the federal funds rate, what it does is it increases the money supply, okay? So lowering the interest rate increases the money supply, increasing the money supply lowers the interest rate. Either way, you end up with a lower interest rate. So what begins to happen then is people are going to borrow more money. People are going to hold more cash and they're going to spend money. And as a result, there will be more demand for goods, which again causes inflation. Okay, so if the money supply drops, say if we move from MS2 to MS1 on this graph, then the opposite is going to happen. We're going to see a rise in interest rates, but also a drop in prices and a drop in the quantity of money. Money would become more scarce, and therefore, when money is more scarce, people have to work harder to find it. They have to work harder to obtain it. They therefore would have to pay more to borrow money. Okay, you'd have to pay a higher interest rate. The interest rate is the price of money. So it's the price of borrowing money. So how monetary policy affects prices, okay? Lower interest rates lead to more investment spending. Okay, when interest rates are low, it encourages people to borrow money. Okay, and we see this in housing prices right now. One thing we've seen, especially in New Pal, is that housing prices have skyrocketed. I have lived in my home for 9 years, 8 years really, but 8.5 years, and the value of my home has gone up by about 80% in those 8.5 years. And you can say that for homes across New Pal. When we bought our house 8 years ago, you could get into quote unquote a starter home in New Pal for $80,000 to $125,000. Today, you're probably not going to find a home like that for less than $150,000 to $200,000, and probably more than that. Why? Well, in part because, quote unquote, the economy is doing better. People have more money, and therefore they're willing to spend it. Number two, there's a huge demand for housing here, and there's still a fairly small supply. We are not building houses as fast as people can move into them. But the third thing that has happened is that home interest rates have been really, really low. Right now, a 30-year mortgage is less than 3%. And so, whereas, it was 4 to 5%, and we thought that was low 8.5 years ago. And so what happens is more people are going to try to buy houses when interest rates are low because it's cheaper to borrow money. As a result, what happens? Well, that increases the demand for houses, and thus what happens to the price of a good when the demand goes up? It's also going to go up, okay? What's also going to happen? Businesses are going to invest more. And so when do businesses invest? They will undertake any project in which they expect to make a greater profit than the interest rate. So for example, if the interest rate to borrow money to build a building for my business is 3%, if I think building that building is going to make my business a 5% profit, I will borrow the money because I effectively make a profit of 2%. Okay, the 5% profit I make minus the 2% interest rate. If it's going to make me anything above a zero profit, I'm going to make that investment. Okay. So what this does is it shifts the aggregate demand curve to the right. Okay. And as a result, prices rise. And so therefore, increasing the money supply, lower interest rates leads to inflation. Okay. So through that Keynesian idea of increasing aggregate demand. Okay. So let's kind of take a look at how this works graphically. Okay. And so, and obviously if we raise interest rates, it has the opposite effect. So let's take a look at how this works. Okay. So we have we've already seen, okay, first things first. Here, let me let me change my curve here. So we've already seen, here's your money demand curve, okay? And like all demand curves, it slopes downward, okay? Here's your money supply curve is vertical, okay? So, okay, if we increase the money supply, that means the interest rate is going to go down, whereas the quantity of money goes up, right? So we have lower interest rates. When there are lower interest rates, businesses are going to spend to expand their business. People are going to spend to buy houses or buy cars or buy, they're more likely to say go to college. So what ends up happening then is, let's go to our aggregate supply and demand curve here. Remember that price level and GDP are our two axes here. So what happens is when there is more supply of money, there's a lower interest rate. When there's a lower interest rate, people borrow more money. When people borrow more money, they spend that money, which of course increases aggregate demand, okay? So as a result, the aggregate demand curve moves to the right. As a result, we have an increase in real GDP, right? We have an increase in output because there's more demand, therefore there's more quantity supplied, right? But we also have an increase in prices, okay? So the inflation rate is going to go up. So when we increase the money supply, it does boost economic activity, but at the cost of inflation. Okay. So this is the basic idea of why, when we lower interest rates, or we lower the reserve requirement and thus increase the money multiplier, or when the Federal Reserve buys US government bonds, which influences the interest rate, that we have inflation. That yes, we have economic growth, but we also have inflation. And that was the idea from the article you read on Tuesday about the Fed chair in San Francisco, or the Fed president in San Francisco, saying, hey, you know what, let's not worry about inflation, let's target economic growth. That was kind of what she was saying is, hey, you know, let's keep interest rates low. If inflation goes above the 2% annual target that we shoot for, fine. We'll let inflation be 3, maybe even 4%. But the key is that we need to grow the economy. We need to stimulate aggregate demand. The heck with inflation. Okay, and that's kind of a very, very Keynesian point of view. And again, remember, Keynesians are all about stimulating aggregate demand. And, you know, a few weeks ago, we looked at fiscal policy, and it's, you know, Keynesians believe in government spending and deficit spending. On the monetary side, they believe that aggregate demand should be boosted through increasing the supply of money, keeping interest rates low. And so we're going to look tomorrow at the concept of monetarism and classical economics, and how do they view the role of the central bank, and how do they view using the money supply. And we'll learn about the quantity theory of money and the equation of exchange, and kind of look at all of that tomorrow. So that's how we'll wrap up today. So the basic thing I want you to get out of today is that increasing the money supply, okay, which again can be done through lowering the interest rate, or the Fed buying bonds, or lowering the reserve requirement, the amount of deposits banks have to hold in reserve. Increasing the money supply will lead to lower interest rates, which will lead to a greater demand for money, which will lead to inflation and also economic growth, at least in the short term. And so obviously the opposite of that is also true. Raising interest rates will decrease the money supply, which will, and again, raising interest rates or raising the bank reserve requirement will decrease the money supply, which will slow economic growth, but it also will stop inflation. So really, and again, that's the tightrope that central bankers are trying to balance. Okay, inflation, unemployment. Inflation, economic growth. Okay, because unemployment and economic growth are kind of intertwined.
Do these central